Hi everyone, it's Quaha with Next Home Wealth Builder here. Recently, I've been diving into a lot of YouTube content about personal finance. One channel I've been particularly hooked on is run by a person named Caleb Hamer. Over the past couple of years, Caleb has been able to build an incredibly entertaining and informative series focused on personal finance and real estate investing. One of the topic I find most relatable is his update on his real estate portfolio. Inspired by those videos and the countless my first rental property stories out there, I thought it would be fun for me to share my own experience. So in this video, I'll walk you through when and where I first purchased my rental property, how I ran the numbers to make sure that the deal worked for me and possibly for you, and a few valuable lessons I learned along the way. So with that, let's jump in. So my first real estate investing journey began in 2007. After earning my bachelor degree in computer information system in 2006, I started working for an IT firm with a salary of 45,000 a year. Since I was living with my family back then, I didn't have many expenses and was able to save a good chunk of my earnings. I was already interested in real estate back then, so I used my spare time to get my real estate salesperson license at a local community college. And by 2009, my older brother, my younger sister, and myself decided to team up and purchase our first rental property. Our focus was on multi-family property for one key reason is to reduce risk. With a triplex or fourplex, even if one unit become vacant, rental income from the other unit can help cover the mortgage. Compare that to a single family rental. If a tenant move out, you're stuck without an income for at least a few weeks while finding a replacement. So here's what I did. Sorry, this is what we did. We pull our saving. I contributed 50,000. My brother added 80,000, and my sister brought in 30,000. In June of 2009, we bought a triplex in Huntington Beach, California. Originally, the list price was 850,000 in late 2018. But then we got it for 543,000 through a short sale because of the market crash. We put down 25%, which is 135,750, as it was an investment property, plus a 7,000 in closing costs for a total investment of 142,750. The interest rate was 4.5% at the time, and each of the three two-bed, one-bath unit went out for 1,500 per month at the time. So here's what our number looked like when we first bought the property. Monthly rental income was 4,500 a month. Expenses include mortgages, which is come out to be 2,063.48 per month. Property tax is 497.75 per month. Insurance is $113.15 a month. Maintenance at 5% is 225. Utility at 5% is 225. Vacancy reserve also at 5% is 225. Property management is around 8%, so that's 360 a month. So our net cash flow is 790 0.65 per month, or $9,487.80 per year, giving us a 6.6% cash on cash return. And now a 6.6% cash on cash return might not seem like much compared to the 10% to 12% return you often see in other states. For example, Caleb Hammer target an 11 to 12% cash on cash return for his portfolio. But here in Orange County, California, a 6.6% return is pretty solid. Plus, over 500 of our monthly mortgage payment was going toward our principal. So adding that to our long-term equity, within just 3 years, as you can see here, our monthly cash on cash return cash flow increased to $1,066.65 a month, or $12,799.80 a year, bumping our cash on cash return to an 8.95. Today, rent in that area average around 25.50 a month per unit, which would push our cash flow to an impressive $3,216.15 per month, and a 27% cash on cash return on our initial investment. This is a perfect example of how real estate is a long-term game. The compounding effect over time is incredible. Now, let's say if we sold the property today, let's fast forward to today, and based on the current estimate, as you can see here on Zillow, Zillow is currently valued the property at 1.374. And if you look over here at realtor.com, you see its value at 1.247. Let's split the difference and say we can sell the property at 1.31. after paying off the remaining mortgage balance of 263,366.65 and subtracting 6% in selling fees and accounting for a 15% capital gain tax, the net profit would be 836,260 and 11 cents. Now divided that by our initial investment of 142,750, and we're looking at a 585% return over 15 years. Not too shabby, right? Anyway, I don't no longer own the property, so that's another story for the next time. But that's it for today. That's my story of buying and managing my first rental property. Real estate investment can be a powerful wealth building tool, especially if you focus on long-term growth and consistent cash flow. So if you enjoyed this video, please hit the like button and subscribe to my channel. It really helps get this content out to more people. And if you have any question about real estate investing, or if you need help buying or selling property, feel free to reach out to me, and I will give you any tips I have. With that, thank you for watching, and I'll see you next